We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Christian, Managing Partner of CPM Group. Thanks for joining me today, Jeff. How are you?
Good. It's always good to talk with you, Tom. We usually have a pretty interesting conversation.
Well, there's never a lack of things to talk about. And of course, being in this space, we were kind of talking a little bit before we hit record here today. It's always kind of a challenge to kind of, let's say, appease everybody, right? I find in this role, you can never please everybody. So that's why I try to understand all of these issues from all sides and really try to get a thorough explanation from, a couple different voices in this space as much as I can. But obviously one of the things that is really topical right now and something that came to mind when I was thinking about having you back on was that, considering the turmoil in the world right now between Ukraine and Russia and let's say the month-old Israel-Palestine conflict, is how much silver gets used in missiles and arms manufacturing and used up in war times.
Yeah, it's not as much as one might think. And, we can go back into history. I mean, if you look at it, the U.S., the National Defense Stockpile used to consider silver a strategic metal. And that's an outgrowth of World War II, when it was actually used in reconnaissance photography was a major application. But by the 1960s, the U.S. government, the Defense Department decided that the silver was not a strategic metal and they didn't need to hold metal on a strategic stockpile anymore. But the Congress blocked them selling it for many years. And there was a workaround, which actually was tied in with the creation of the Silver Eagle, which used the strategic stockpile in a way that Congress couldn't argue would disrupt the silver price. But if you look at it, recently I was quoted as saying that the amount of silver used annually in defense and military applications globally probably is between 10 and 50 million ounces. Mm-hmm. And that was a guess based on what we know about military uses and military stockpiles of silver around the world and such. And in retrospect, I think it's probably closer to 10 or 20 million ounces than 40 or 50 million ounces. Okay. And it's very interesting because people will say, well, look at all these bullets that are being shot. Bullets don't contain silver. Except, what was it? The Lone Ranger, I think, had silver bullets or something like that.
And probably some vampire movie too.
Yeah. Bullets don't have silver. Torpedoes and missiles have silver, mostly in their batteries and in their electronic controls. Mm-hmm. And it's not a lot per missile, but the way things are going in Ukraine and in the Israeli-Hamas war, there are a lot of missiles being fired, Mm-hmm. So you do have silver used in batteries and electronics in missiles, and those batteries get swapped out from time to time so that they're always fresh and charged and things like that. So there's most major governments have a stockpile of silver that they use to rotate so that they have working inventories of those batteries. It's probably closer to 10 or 20 million ounces. The thing about torpedoes and missiles is that when you use them, you don't recycle that silver. You don't recover the silver. It's gone. But it's there. The other thing to pay attention to, which people don't realize, I mean, if you look at defense spending, the United States military spends more on defense than the next 10 countries combined. We put that in a recent market alert that we sent out to our clients talking about budget and such. So when you start saying, well, how much silver is used? Well, you can say, okay, this is how much we estimate in the U.S. military. And then they say, well, what about all those other countries? Well, all those other countries combined aren't as big as that. So you can double the U.S. and you pretty much have what's on a global basis.
Mm-hmm. Jeff, I remember seeing at one point that there were, certain kinds of missiles or arms, and forgive me because I can't remember exactly what they were, but somebody had told me that there were, hundreds, if not thousands of ounces per missile being used. Is that not the case anymore, to the best of your knowledge?
It was never the case.
Okay.
Yeah. I remember people saying that, and it wasn't true. Yeah. Mm-hmm. It's a matter of ounces, not thousands of ounces per missile.
Okay. So as we consider, this time of conflict, I had a guest on the other day that called gold really a chameleon trade. And I wanted to get your take on when gold really acts as a hedge, let's say against geopolitical instability, against inflation. It seems that at different times it has different roles, whether that be, to hedge against these periods of instability. So how do you see the role of gold in those different applications, and how do investors change their appetite in those times?
That's a point that we've been making since the 70s. And we actually have a matrix that we use. We talk about the 6 sets of factors that cause investors to buy gold. And let's see if I can remember them. As an inflation hedge, as a currency hedge, as a portfolio diversifier, as a commodity, as a safe haven against political, economic, and financial unrest. And what was the 6th? I think that's 5 as a commodity and as a form of savings. And one of the points that we've often make over the last half century, it has been that if you look at gold and say, well, I know people and very prominent hedge fund managers who will say, all you need to know about gold is the dollar, because gold trades against the dollar. Mm-hmm. But if you look at it statistically, gold trades against the dollar about 1/3 of the time. And the other, another 1/3 of the time, gold moves in line with the dollar, up and down together, as is the case now. And in other times, there's just no correlation. And if you look at gold as an inflation hedge, I know people who say all you need to know about gold is it's an inflation hedge. So if you know inflation, then you can, gold. And the correlation since 1968, when gold prices were freed, to changes in the CPI versus changes in gold prices is 9%. So 91% of the time, no, gold's not a good inflation hedge. And we have this matrix, and we color code the things. We give probabilities. At any given time, are investors interested in buying gold because it's an inflation hedge, a currency hedge, a safe haven, a portfolio diversifier for commodity reasons, or merely as a form of savings? Mm-hmm. And we do that. And then you have a chart that right now is like all 6 factors are shining green. Buy gold. Yeah, because we have greater risks now across the board than we probably have had for a long time. Mm-hmm. Gold's a chameleon trade, and that's one of the neat things about gold. It's one of the things that attracted me to studying gold starting in the 70s, was that you get to, and you have to, get into all of those different things very well. I had a guy who wanted to compete with us as a gold analyst in the 80s, and we were right and he was wrong. And some reporter asked him, why is that? And he said, Jeff Christian isn't really good at predicting the gold price. He's just good at predicting global economics and the stock market. Yeah, because those are 2 of the factors that drive it. And I think one of our strengths has always been an accurate assessment of global economic factors, the currency market. We have been, it's not that we're more bullish on the dollar than others. We're less bearish on the dollar than we are on all other currencies. So we have not predicted the dollar is going to collapse. you know? And so we've been right. And that's one of the neat things about being a gold analyst is you have to pay attention to all of these different factors.
Mm-hmm.
Yeah. In the 1970s, I was involved in a company, working for a company that we created a newsletter on fertilizer markets, and it's still around. And you hire these people to write about potash and nitrogen and phosphates. And one of the guys asked me to have lunch with him one day, and he said, "I'd really like to write about, global economics and politics and stuff." And and I said, we all would. And he said, "No, you do, because you're following gold. And what the reason I wanted to have lunch with you is to see if I could work with you on the gold market." So it's there, and yeah, it is, and it makes it more difficult because right now, for example, you see people liquidating some gold positions because inflation rates are coming down. And they had bought gold 2-3 years ago because they were worried about 8% inflation, but now inflation's 3 or 4%, depending on if you use the PCE or the CPI. And so they're saying, okay, that inflation, that phase of inflationary period is over. You have other people who are buying gold because of issues related to interest rates, other people who are buying gold and buying the dollar because they're worried about the state of the world. And so you have all the kinds of different factors that you have to pay attention to get it right.
Well, I think I would say the most important point. And I think the most difficult point to really understand about this market is that it is very multifactored. It's not just as simple as understanding the dollar or understanding inflation. There are many different pieces of this puzzle that are moving all the time, that it does take a lot to try to understand it, to be able to, let's say, paint a realistic picture of what is really driving the price of the precious metals. So
yeah, realistic is a very important term, because another aspect of the gold and silver markets are their asymmetry. There are very few people who really have good handle on what's going on in gold and silver. And there are a lot of people who don't have a good handle on it. And there are a lot of other people who bring baggage to their analysis. So they're convinced that there's some, that the government's going to collapse, or the bond market's going to collapse, or the dollar's going to collapse. And they bring preconceived notions, and then they look for confirmation of their beliefs, rather than taking a realistic normative view. Well, really, where are we right now?
Mm-hmm.
Yeah.
Well, Jeff, all of that considered, we have much of these factors being green, as in buying gold, and I believe that was kind of the bubble chart that you and I have gone through a couple episodes ago. What do you see right now, conversely, as headwinds for the precious metals right now? Is the economic situation in the U.S. really dampening demand for the metals based on, as you said, inflation, based on job reports? What is acting as a headwind right now?
Yeah, I think right now our analysis is that there are short-term headwinds that are not long-term headwinds. Mm-hmm. So, you've had a situation where people were buying gold because of inflation, or they were buying gold because they thought the dollar was going to rise, or they bought the gold because they thought we were going into a recession. And they were fear trade. It was a fear trade, and a lot of those things haven't happened. Doesn't mean that they're not going to happen next year, but they haven't happened in 2021, 2022, 2023. Mm-hmm. And so you have some people who have been pivoting away. And, there's a scene at the beginning of the Pink Panther movie where there's this old man sitting in a piazza in Italy, and there's this car chase, and it's going past him on this side, and it's going past him on that side. And I compare CPM Group to that, because we've been sitting here saying this is what we expect economically. We saw inflation picking up. We saw it as transitory, but it would take several years to dissipate. We saw interest rates rising. We saw that as a headwind for gold, but not a big headwind, because it really takes 3% or more in terms of real interest rates to turn investors away from gold. And we didn't see that coming. Even at 4% inflation right now, that would imply 7% interest rates. And I don't know any mainstream actual economist that follows fixed incomes that's talking about 7% interest rates. Fed certainly isn't talking about it, and most banks aren't, and we're not. So you have a situation where people were saying, "Oh, we're going into a recession with high inflation, and the Treasury market's going to collapse, et cetera, buy gold." And now the same people are on the other side of us saying, "Okay, we're not going into a recession. Maybe we won't ever have another recession. And inflation is coming down, and interest rates are not so high as to turn off gold investment demand." And so they're pessimistic about gold. Mm-hmm. And this is probably the 11th hour. Yeah. And we're sitting there like, no, just because it didn't happen in 21, 22, 23, the way we said it wouldn't happen, doesn't mean it won't happen in 24, 25, which is what we've been saying for several years. We have been expecting problems to emerge in 24 and 25, recession, financial market instability, political instability on both a domestic and an international basis. We thought that all of that stuff would get much worse in 24, 25, and we're still saying that. But a lot of other people are saying, no, we're not going to have a recession. It's quite clear. And that's a short-term headwind. And I do think that, the politicians around the world will work very hard to convince people in early 2024 that they shouldn't be so optimistic. In other words, politicians will muck things up. Mm-hmm. And I do think that there are going to be a lot of problems. So it's a short-term headwind, this optimism about the economy and the world. Mm-hmm. And we think it dissipates over the next 12 months.
So, Jeff, how do you see, let's say, the path forward for inflation from here? We have seen it come down quite a bit, but as we've seen, in the recent past here, for example, the renegotiations of the auto workers' salaries here going up by 25% over the next 4.5 years. To me, that seems, as one piece of an inflationary driver going forward here. So how do you see inflation going forward, let's say over the next, kind of medium term, let's say 2 to 5 years?
Yeah, we've been talking for years. Our view was that inflation wasn't an issue, deflation was. And you have surpluses in, manufacturing capacity, labor, commercial real estate, and retail capacity that could have deflationary pressures in the long run. Mm-hmm. The COVID, the lockdown, the recovery have all sort of postponed that long-term problem. We see some inflationary pressures coming off. Energy, we saw oil prices rise sharply. Now they've come back off. They're very volatile at present, but it's interesting watching the Middle Eastern political situation right now. It's quite clear that oil exporting governments do not really want to use oil as a weapon at this point. That could change depending on how the war proceeds. But for now, it looks like it's not there. Food inflation is very problematic, and labor is playing catch up. Yeah. So, we have the UAW, we have had a couple other things. You're seeing people move back toward collective bargaining, and that could have some inflationary conditions. Mm-hmm. That we think in the intermediate term, you could see inflation basically staying, 3 to 5%, 3 to 4.5% for the next year or two because of some of these cyclical inflationary pressures. The food price inflation is really worrisome because that's not cyclical. That has to do with climate change really disrupting growing seasons. And we've had crop failures and floods and heat waves from Georgia through California in the United States. We've had them in Southeast Asia. We've had them in China. We've had them in Europe. And that's constraining food supply at a time when, quite frankly, people are hungry. Mm-hmm. So we think that food inflation could stick around for several more years and be there. That'll keep inflation higher. Labor, we still see a surplus of labor on a global basis. It's been disrupted by a variety of issues with immigration and such. So we think that the collective bargaining that's leading to some catch up in wages will be an intermediate inflationary factor, not the key one, but that over time it will dissipate and we'll flip back to the realization that on a global basis we have a surplus of labor.
Mm-hmm. Jeff, you mentioned energy prices and specifically oil prices kind of at the beginning there. And earlier we talked about this strategic reserve that the US had of silver, but we've seen the US sell off much of its strategic reserve of oil. How do you view that situation now going into a time of conflict? And how do we refill the strategic petroleum reserve to a point that really held a lot of safety for the country for a long time?
Yeah, I think it was an incredibly unethical and unintelligent thing to draw down the strategic petroleum reserve. And a lot of people in the oil business and in the oil government aspect of the energy market also thought it was ill-advised to do that. And it's going to be difficult to rebuild that because you're talking about, oil's probably going to trade between, say, $70 and $85 or $70 and $90 over the next couple of years, with the potential of spiking higher on political problems. You've got a much more expensive refill than the original oil reserves, many of which were bought at, $15, $20, $25 a barrel. But it does need to be refilled. And unfortunately, the price is going to be a lot higher this time. So I think it was really dunderhead move. But no one's ever accused the government of being intelligent.
Yeah, we're facing prices that are 3 to 4 times that price level that it was originally filled at.
Right.
Jeff, one thing you and I have spoke about in the past is asking the right questions and being open to all kinds of information, even if it goes against what you want to believe. So one of my goals with this show is to challenge my own biases and try to get information from all sides to explain what we're seeing in the market. So how do you view the adjustments to government data sets over time? And how does that really give us a particular barometer by which to measure the economy?
I happen to think that there's a lot of misunderstanding about government statistics. And I happen to think that adjusting inflation factors on an annual basis, which is what the BLS does, makes sense. And adjusting for the quality changes, the heuristic changes and stuff. I think all that makes sense. And I think that the CPI is CPI, the PPI, the PCE. I think these are all very good efforts to estimate inflationary pressures. And if you look at the CPI, you have I think it's more than 3,000 households across the country that voluntarily keep track of everything they buy every month and what they pay for it. And they send these forms into the Bureau of Labor Statistics, and the Bureau of Labor Statistics compiles what people are actually paying. Now, they don't do that for 380 million people. They do it for 3,000 some odd households. So it's a survey. It's not a census, statistically speaking. And I think some people don't understand that. They also don't understand that every year then the BLS says, okay, the pocketbook, what's being bought shifts. And we adjust our index to accommodate what's happening in terms of where people are spending their money. So for example, in the last few years, after the lockdown, you've seen a big, for the last decades, several decades, you saw a big shift away from the amount of money being spent in this survey of households spending money for food purchased for consumption at home. That was declining sharply, as was the percentage of money spent on energy, electricity, heating oil, natural gas. Those fell in terms of what people were actually spending their money on. And you have critics who don't understand that, and they say, well, they've lowered the amount of energy and food in the index to make inflation look lower. And it's like, no, they lowered it because people aren't spending as much of their money and this percentage of what they're spending on those two factors. Now, at the same time, you had over the last several decades a big increase in the amount of money spent on food purchased for consumption outside of the home. With COVID and the lockdown, you saw a flip on the food. So people are buying more, spending more money, more of their dollars that they're spending are being spent on food for consumption at home and less outdoors. Now that puts a squeeze on restaurants, so they raise the prices because they have to try to be profitable with fewer meals. So I look at the CPI, I look at the PPI, I look at the studies, and I've gone to these conferences and actually, these people who criticize the CPI and they say that there is some political rigging going on. There are thousands of economists or hundreds of economists at the BLS that work on this that are not political employees. They are government employees. They have no political union that they belong to. They work as economists trying to get it right. Economists and statisticians trying to get it right and trying to get it accurate. So there's no political thing there. But then I pick up the monthly BLS CPI report or PPI. I'll carry a copy with me to these presentations and say, this is the 36-page or 48-page CPI report for last month. How many of you have read it? They don't even read it. They don't even know it exists. And they don't know how the data is compiled. So they don't understand it's a survey, not a census. Government doesn't go to the population and say, you must fill out a form every month saying, hey, this is where I'm spending my money. They have volunteers who say, I will take this book that you send me every month and fill it in. And I think there's a tremendous amount of misunderstanding as to what these surveys are and what they represent. It's the man in the white coat. Is a guy in a lab coat? Well, he must be an expert on the subject. Not necessarily. Well, he is, but you have to understand what he's saying to you. I've taken some criticism recently for some of the stuff I've said in videos, and you listen to the critics and you say, I don't think he actually listened to my thing. He must have been told what I was saying because he clearly had no understanding whatsoever of what I was saying. But then I guess my wife tells me that's often the case with me.
As we're speaking about misunderstandings, Jeff, I want to dig into how much gold central banks are really buying. We keep hearing that we've seen several quarters of record buying, but you recently said that it's probably not as much as we are led to believe.
Right. Well, there was a miscalculation by a marketing group last year, and they overestimated what central banks were buying. And part of the problem is that central banks are more transparent than they used to be. And then you have to understand what they're saying to you, and you don't necessarily understand what they're saying to you. And they say, and then so you listen for confirmation as opposed to comprehension.
Like a game of telephone.
There used to be a joke in the 80s that no one understood what Alan Greenspan was saying when he was making his pronouncements at the Fed, except Jeff. And Alan and I get along great, and we understand each other. And he was actually Paul Volcker and then Alan Greenspan were the beginning of this era of the central bank needs to be more transparent and more forthcoming with information. And we've seen times like, for example, when Janet Yellen was in charge of the Fed, she would have a press conference and she would say stuff and no one got it right as to what she was trying to tell you and trying to convey to the public. So that's a real problem. Now, one of the things that people don't understand is that in a lot of countries, not in the United States, but in China, in the Philippines, and Brazil, and other countries, the central bank will be a market maker for, and when I say a market maker, I'll say they're buyer and seller, because clearly some people don't understand what making markets means. And that's one of the criticisms that people just didn't understand what I was saying in recent videos. There'll be a market maker for national buyers and sellers of gold and silver. Mm-hmm. And in China last year, you saw a very strong demand in the first quarter from jewelers, from investors, and from companies that supply gold to jewelry manufacturers and companies that supply gold to investors. And then in April of last year, that demand just collapsed. And you had a 74% decline in the amount of gold that was being bought by private entities and corporations and investors in China. Now, the Chinese government has a policy, the gold in China stays in China. So if you want to sell excess inventories, you're a jeweler and no one's buying your gold jewelry, you've got excess gold inventories, you want to sell them, you try to find a Chinese buyer. And the same is true if you're an investment supplier, a wholesaler or retailer, and your investors are selling gold back to you, you have to find a buyer. If you don't find a buyer in China, you go to the People's Bank of China, which has a side pocket, a trading account, and you say, I have this gold that I want to sell, but I can't find a buyer in the Chinese private market. Can you find a buyer? Mm-hmm. Now, someone found out that with the collapse of private sector demand in China last year, about 10 million ounces had built up in this side pocket at the People's Bank of China, this trading account. It wasn't monetary reserves. It was a trading account where they were looking for buyers for third-party clients, if you want, the customers. And they said, the People's Bank of China bought 10 million ounces of gold, which means that total central bank gold last year would be 20 million ounces, which is the highest level since the 1960s when gold was used for international currency trade settlement, trade and capital flow settlements. But that wasn't true. Central bank buying for their own account, China didn't buy any gold from January until November of last year. They bought 1 million ounces in November. They bought 1 million ounces in December from that pocket. The price had gone from $2,060 down to $1,624. The People's Bank of China said, we haven't bought any gold since 2019 when the price was $1,200, $1,300 an ounce. It's not back there now, but it's dropped 25% from 2,100 down to 1,600. So this is probably a good time to buy. So they bought 1 million ounces in November. They bought another 1 million ounces in December. They bought 2 million ounces in total last year in the final 2 months of the year, not 10 million ounces, right? And then they bought another 6 million ounces or 4 million ounces out of that so far this year. So that then led to this thing. Now, central banks are buying a lot of gold. They're buying about 10, 11 million ounces of gold this year. That's a lot of gold. Mm-hmm. Not 20 million ounces. It's not a record level. And they're also, conversely, they're not dumping treasuries. They're not dumping the US dollar. Yeah.
Well, I've seen some recent charts showing that China is selling treasuries. So are we making a difference in terms of dumping versus selling?
Well, there was $1 trillion treasuries that were sold over about a 1 year period. And what was happening, Stan Druckenmiller made a comment about the Treasury's management of its debt. And it's funny because what he said was true, but it was politically funny.
Unpalatable.
Yeah. He was right. They should have refinanced their debt at lower interest rates. But if the Treasury had said, hey, we have $30 trillion worth of debt and we want to sell it and replace it with 25 basis point interest rate paying things, it wouldn't work politically. Anyway, there was $1 trillion of treasuries that were sold. These were treasuries that were bought from 2008 to 2019, 20, 21, and they had very low interest rates. Interest rates started rising. These things were dying in terms of value. They were bad investments. 700 billion of the trillion, 70%, were sold within the US market. 300 billion was sold in overseas markets, mostly, well, perhaps 100 billion of it was sold by US investors, investment funds, and corporations that are holding their money offshore for tax avoidance purposes. And then, like in China, you had, I think, about 100 billion. No, it wasn't 100 billion. You had private holders of treasuries in China selling, and the People's Bank of China did sell, I think, about $14 billion. But what they were doing was they're getting rid of low interest treasuries. Once the interest rates started looking like they were peaking about 4 or 5 months ago, you started seeing all those people starting to buy treasuries again, including central banks. Okay, I got rid of the stuff that was paying 25 basis points, and now I'm replacing it with stuff that's paying 5.25. And that's actually an interesting piece of data, because that tells you that sophisticated central bank and institutional investors think that the interest rates are close to, if not at, their peak.
Yeah, that's a really interesting explanation, Jeff, and I appreciate you going through that. And this kind of brings up the idea to me, and as I was preparing for today, about really using bad data. If we are seeing, let's say, shortfalls in supply for silver, for example, using that bad starting point, I think it comes back to the old saying of garbage in, garbage out, right? If we're using a misleading data point to begin with, let's say that there's a supply shortfall of several 100 million ounces in the silver market, then of course you're going to get a misleading endpoint to that equation, let's say. So is there a major demand shortfall of production looming in the silver market for what is being demanded here?
No. CPM Group was created as the research department at J. Aron in the late 60s, at a time when it was clear that the dollar gold standard was going to end and gold was being freed to float price-wise around the world. And silver also was being demonetized out of silver coinage in the 60s. And the brains, the geniuses at J. Aron senior management said, these are asymmetrical markets full of bad information. And if we could develop a somewhat better flow of information, we can beat the market regularly. And, starting in the 60s at J. Aron, when I was in grade school, I was involved in the copper market with scrap wire, but we won't go there because, the statute of limitations is over. But that's beside the point. We've proven it over the last half century that a better flow of information gives you better investment results. Now, you look at the silver market, and it hasn't been in a deficit. It's been in a surplus of newly refined silver entering the market relative to fabrication demand. You don't include investment demand, because investment demand for silver doesn't change the nature of that silver. It's in a coin or it's in a bar, and it can be sold at a moment's notice. And there are other factors too. Investment demand tends to be positively correlated to the price. Investors will chase the price higher, where fabricators will reduce their demand for silver as the price rises, because it's raw material for their products, and it's become more expensive. So there hasn't been a deficit, and there probably will not be a deficit. I'm not quite sure what our long-term projections are on an ongoing basis. In addition to which, you have a lot of metal above ground in above ground inventory. So we see tighter silver markets, but we don't necessarily see these yawning shortfalls in terms of fabrication demand versus total newly refined supply.
You know, Jeff, when we consider, let's say, the balance of monetary demand or investment demand for silver versus the industrial demand, how do those roles shift at different times? Is it really, a balance, as you just said, where when prices rise, investors tend to chase it, yet manufacturers of raw goods end up reducing their demand because of that price rise?
Yeah, the roles change over time, but one of the things you have to understand is, if you're a manufacturer, you're in the business of making things and selling them. And you need to supply the raw materials. As the price rises, you can, if you're a jeweler or an electronics manufacturer, you can actually reduce your per unit use. And jewelry manufacturers will talk about there's a price point, and we have to keep these pieces of jewelry affordable. So as the price rises, we use less gold per piece. In the 1970s, I remember when the gold and silver prices were starting to rise, I asked someone at IBM, this was prior to desktop computers, so it was mainframe computers. I asked somebody in procurement at IBM if the higher gold price was going to lead them to shift away from gold in their contacts and connectors. And they said, no, the price of gold is minuscule. The price of gold in one of our mainframes is minuscule compared to the price that we charge for that mainframe. So it's not an issue. But I knew that GTE Sylvania sold the contacts and connectors to IBM. So I called somebody in procurement there, and he said, oh, this was 1979. He said, we shifted the IBM contacts and connectors from gold to palladium in 1975. IBM didn't even know it. They were, or that guy in procurement didn't know it, but they were using palladium contacts and connectors instead of gold because of the price differential. $45 for palladium and $300 for gold at the time. So yeah, it does vary over time. But the thing about it is that the fabricators need that raw material, or they can substitute out. But they have to do their business. Now that's their business. So they're going to be buying. They might hedge, they might buy forward, they might use some sort of financial sophistication to protect themselves from those price changes, but they're going to be buying that material. Investors don't need to buy, don't need to sell, don't even need to be involved in gold and silver. So they have greater flexibility in whether they're buying and selling. And because when they do buy and hold these metals, they keep the metal in fungible form that can be sold at a moment's notice, they can move very quickly. So you'll see investment demand as the marginal buyer or seller of these markets, and consequently, they will be much more powerful in their effect on the price.
Because of that quick liquidity, as you're saying.
Flexibility, total flexibility. I don't have to be here. But also, the fact that they can, it used to be that, prior to ETFs, if you had a physical gold or silver and you wanted to sell it, it was a 2-day settlement. You'd call up a bank or a trading company and say, I have this gold that I bought from you a long time ago. I want to sell it back to you. And over 2 days, you would sell it. Now with ETFs, it's literally a blink, pressing a couple keystrokes on your computer. You don't even have to interact with your counterpart. You don't have to worry about a banker or a trader saying, do you really want to sell at this price?
So, Jeff, when we think about silver being treated as an industrial metal for use in, photovoltaic cells, electronics. How does this also affect the demand for silver for the foreseeable future?
Well, silver will do well because of electrification and also solar power. And, if you look at the various energy transitions that are underway, electric vehicles they've accelerated, but now they're starting to slow. Wind has a lot of headwinds, excuse the pun, because people don't want windmills in their neighborhoods. But solar power is fully financed and is there, and it's growing sharply. So they're going to be using a lot of silver, and that's going to increase the fabrication demand, as will other electronic and electrical applications growing, and the use of silver, in cars. A typical car uses a little bit more than an ounce of silver, and a typical electric vehicle uses between 1.5 and 2 ounces of silver. And so you'll see demand growing in those applications, as well as other applications for silver. And that will limit the flow of new metal into the silver market that's readily available for investors to buy, which means that if investors want to buy 100 million ounces or more in a given year, they're going to have to bid the price up to encourage investors who had bought earlier to say, oh, well, I've got this silver that I bought at $15 in 2019. I'll sell it to you for $30 today.
Jeff, you bring up an interesting point about let's say, the changing dynamics within the auto industry. Do we see, is it more electrification, or do you see a resistance like we've seen from Toyota, for example, kind of focusing its energy on other technologies other than just electric cars?
Having written about electric vehicles in the 70s, at the turn of the last century, around 1900, most of the auto industry, the auto market was nascent. It was just growing. And most of the vehicles were electric vehicles powered by lead acid batteries. The internal combustion engine was just being really refined. I mean, it had been invented in 1806 using hydrogen as the fuel. Commercial oil production only began like in the 1860s. I think it was 1860s, maybe 1880s. So the internal combustion engine was slow to come, but the internal combustion engine supplanted electric vehicles, and electric vehicles at the beginning of the automotive industry were a interim or, a bridge technology. Our view is that electric vehicles may be a bridge technology now, and that may be a very important bridge for the next 40 or 50 years because they're here now. But that we probably will see other technologies. And you mentioned Toyota. Toyota a couple months ago unveiled a hydrogen engine. And hydrogen engines are something that really are interesting to me because they cost half as much as a petroleum-powered internal combustion engine. They burn hydrogen, and they cost about 1/10 of what batteries cost, and they cost like 3% of what a fuel cell stack costs. So they really have a big cost advantage. The problem is getting hydrogen to the vehicle in a safe and affordable fashion, and that has to be worked out. But Toyota unveiled an 8-cylinder hydrogen engine a couple months ago. And BMW has been working on hydrogen engines. Ford, General Motors, other auto companies have been looking at hydrogen engines for decades already. So, the real key is getting hydrogen safely and cheaply distributed to end users. So our expectation is that electric vehicles will take market share for decades to come, slower than a lot of people think because of a variety of capital and logistical and raw material issues, but that they may ultimately, 80 years from now, be looked back on as an interim technology. And it's not just recently Ford halted construction of a battery factory And they said, the CEO of Ford said, electric vehicle demand is slowing. And there are a lot of issues related to electric vehicles, and we're not quite sure about their future. Mm-hmm. So there's a lot of uncertainty as to how that all transpires.
Mm-hmm. Yeah, it's interesting to try to consider as you said, the delivery challenges of hydrogen, as well as the economics of actually producing hydrogen at I don't know what you want to call it, at an industrial scale, at a consumer level scale. Just the amount of hydrogen that we're going to need if the world takes that path, I think, is going to be a challenge.
Right. Yeah, there are a lot of challenges in the energy transition that I think a lot of politicians and high-level corporate people sort of ignore, or they belittle them. And I think that they're going to be factors that slow the change in mode of transportation technology.
Mm-hmm. Jeff, as we talked about kind of the resolution of a lot of these auto industry labor disputes here, do you see a resumption in demand for platinum and palladium here?
Some platinum, not palladium. We have a relatively negative view on the long term for platinum and palladium. There is a shift away from palladium toward palladium and rhodium toward platinum, which will help platinum some. But just looking at the state of the auto industry globally, as well as the shift to electric vehicles, we don't necessarily see these as good investments anymore.
Jeff, there's no good transition to this, but it was something I wanted to get your thoughts on. Something we haven't heard much about in the last little bit here is the debt ceiling. And considering that it was deferred until January 1st, 2025, does that really set us up for an even more dramatic time to get a resolution of it at that point?
Possibly. Yeah. I think, we were talking earlier about the idea that a lot of investors have shifted from expecting an imminent recession to being, maybe we won't have recessions anymore. One of the pillars in this, what we consider unreasonable optimism, is that a lot of people have looked at the way the dysfunctional government operates. And with the most recent, 11th hour continuing resolution to avoid a government shutdown, and they'll have another one next week, right? I think a lot of people have said, the U.S. government is a joke, and they create problems and then they fix the problems, and then they want people to be grateful that they fixed the problems they created. And the debt ceiling is the same sort of thing. It's just like, it's a nonsensical type of thing. It's not what you should be paying attention to. But if we can distract people by worrying about the debt ceiling, we don't have to talk to them about the substantive issues as to what we can do about reducing our debt. And there are real things, but they're painful to talk about, so you don't. It's like when I was in high school and my mother would complain about my long hair, and I would say, "Why are you complaining about my long hair?" She would say, "Do you want me to complain about the real things?" And I said, "No, complaining about the long hair." So the government distracts us with these debt ceiling things. It should be resolved on a permanent basis just by getting rid of it. And saying, let's focus on reducing the debt as opposed to raising the debt ceiling. But that's a painful discussion that politicians don't want to have with their voting public. So that's not going to happen. It could happen, it should happen, but I don't have a lot of optimism about the government becoming effective.
That's a very generous way to put it, Jeff. As we look forward, really for the next year here, coming into this next election, to me, it seems like it's going to be a very tumultuous time. How do you foresee the next year and a half coming into this election, and maybe the drama around the election going?
I think it's going to be extremely tumultuous and very unnerving and very risky. And I think that all is going to factor into, we're talking about sharp increases in gold and silver prices next year. And one of the factors that's factored into that projection is very risky, uncertain, dangerous political situation in the United States government and similar problems in other countries and other jurisdictions. But the U.S. is the largest economy, the largest military, and a variety of other things. So people will focus on it. But I think it's going to be extremely dangerous, and that's going to help stimulate. It's going to be one of the factors flashing the buy gold and silver sign over the next year or so.
So when you're talking about a sharp increase, let's say in the next year here, what kind of percentage or targets do you guys have? Just to be a bit more specific on that, because I know we'll get lots of questions about that.
On an annual average basis, we predict highs and lows too, but on an annual average basis, we've had record prices for the last 3 years. $17.99 average price in 2021, record. 1804 last year, new record. This year, the average price will probably be around $1,950, which is right about where we are right now. And that'll be a record. Next year, we would not be surprised to see the gold price average more than $2,000. It's only like about a 7 or 8% increase on an annual average basis, but it's over $2,000. Mm-hmm. Now, if you're going to have an average price of, let's go back to 2011. The price of gold got to $1,998 or something like that, but the average price was like $1,600. So if you're going to have an average price of $2,000 next year, you're going to have a spike well over $2,100 at some point. How high that spike goes, I don't know. Could it go to $3,000 for a minute? Sure. If you go back to 1980, the price got to $850 for a minute, or about 3 minutes actually. The average price that year, I think, was something like $600. Mm-hmm. So we think in terms of annual averages when we're making our long-term projections. That's gold, and we think it could be over $2,000. And there'll be people saying, "Why is gold price so low?" Silver, we also expect the price to rise. We don't see record annual average price in 2024. It's possible. I think the average price, record average price was probably around $35 back in 2011. And I'm not sure that we will get that high on an annual average basis. I think right now we're probably talking about $28 to $30 on an annual average basis next year, and then maybe higher in 2025 before it comes back off. So we're looking at a sharp increase. If you go from $22 today, $22.50 today to $28 or $30, that's a big increase in a percentage term on an annual average basis. Mm-hmm. And it also implies that you would see spikes higher.
Right, because of that momentum chasing that price at that point. Yeah.
Right.
Excellent, Jeff. Well, as we wrap up here, is there anything else you'd like to leave our audience with today?
Well, I think that we've pretty much covered the waterfront here. Obviously, people can go to our website, cpmgroup.com. They can get other free reads and see other videos and reports that we put up there for free. Mm-hmm. And they can buy our gold or silver or platinum yearbooks, and they could, sign up to be clients in other ways, shapes, or form. We've done a couple market alerts that we sent out to our clients on our long-term economic outlook and the concept of debt deficit, debt, and gold, why you should own gold given the deficit and debt situations. And we also compare that to historical patterns and how we got out of the fire last time around back in 1947 through 1981, and how we could get out of it this time. So we have those market alerts that are available for clients, and people can go to cpmgroup.com or send an email to info@cpmgroup.com and say, I want to be a client because I want to get those 2 market alerts. Yeah.
And you guys also have a CPM Group YouTube channel where you do fairly frequent updates as well, right?
Twice a week, yes. Or twice a week.
Mm-hmm.
We try to do those. Yeah.
Excellent. Jeff, thanks so much for your time today.
Well, thanks for having me back on. I always enjoy our conversation.
Excellent. Thanks, Jeff.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.